Hi everyone. I thought I'd show you an approach to this type of problem in accounting. What they're doing is they're giving you some transactions here. So during November of 2014, these transactions occurred. So we'll go ahead and take this out for now. We won't look at it. And then they're giving you the beginning position. You'll notice that the beginning position pretty much mirrors what we have here at the top. The accounting equation pretty much is here. So we don't really need to work with this very much because we have it here in front of us as far as the beginning position. Let's start looking at some of the transactions that we have here. Looking at the first one, we have the business received cash of 4,400 and issued common stock of 4,400. So obviously we're getting some cash in, and then we are issuing some common stock in the amount of 4,400. And be sure and put the type of equity transaction. You don't have to put the type on the others, but on this type of problem you do. Uh, so here we're basically issuing common stock, so issued stock. Go to the next one here, B, performed services for a customer and received cash of 6,900. Well, obviously cash is going to go up and retained earnings is going to go up. And for this amount, what we have is the 6,900, the type of equity transactions. Retained earnings went up because we received service revenue. Let's go to the next one, C, paid 4,400 on accounts payable. Well, obviously, if we pay, cash is going to drop. That's a negative 4,400. But correspondingly, accounts payable is going to drop as well. In other words, we will not owe as much. On D, purchased supplies on account. Well, the first thing that's going to happen is if we purchase supplies is they're going to go up. And we say we purchased on account. We didn't pay cash. So that means that supplies are going to go up, but our accounts payable, how much we owe, is also going to go up. If we had paid cash, it'd be negative 1,400 here, and it would be negative 1,400, positive 1,400. This wouldn't be here, and we'd still be in balance. Since this is a liability, we're paying it with an accounts payable. Assets go up 1,400, but correspondingly liabilities go up 1,400 as well. Let's go to E, collected cash from a customer on account. So if you collect cash, obviously your cash is going to go up. And this comes from an accounts receivable. You're collecting it from a customer on account. That means that you had an accounts receivable with that customer, not a payable. That's what you pay the outside world. This is incoming to you. So that's going to drop by 1,600 because they don't owe you as much anymore. No one does. This accounts receivable is what the company's owed by everyone. Let's go to F, consulted on the design of a computer system and billed the customer for services. Okay, so if we bill them, that means we're not collecting it. We're not actually collecting the money. What we're going to do here is we're going to set up a receivable for 4,300. And then it's for services that we rendered. So retained earnings are going to go up. We've earned our service revenue. And this type of equity transaction, in other words, the $4,300 of retained earnings we're going to increase, is service revenue. On G, recorded the following business expenses for the month. Well, we paid office rent of $1,600 and we paid advertising of $1,400. Well, that means cash is going to drop by $3,000. So that's kind of a negative. In addition to that, though, in addition to paying that amount, one of the things we're going to see is we're going to see the other side of the equation line up as service expenses. So we're going to have expenses here of $3,000, which lowers retained earnings by $3,000, and this is categorized as expenses. Expenses are causing retained earnings to drop by $3,000. That's $1,600 plus $1,400. H, declared and paid a cash dividend of $2,900. Well, if we pay a dividend, then we're obviously going to drop $2,900. Also, if we pay a dividend, our retained earnings are going to drop because some of our earnings that we have we're giving away in the form of a declared dividend. So this will be a drop in retained earnings of 2,900, and this is a dividend declaration. So we're paying dividends. Okay, so here the rest is pretty easy. You sum it up. You sum all these up and put the totals up. You end up with the total assets. You end up with the total liabilities and stockholders' equity. I'm not going to do the math for you here. The big thing I was trying to do is communicate, hey, this is how you handle this type of transaction A to H when looking at the accounting formula. And you want to make sure, notice the patterns here, that if cash goes up, either a receivable is going down because you're collecting a receivable, or you're collecting cash and you have revenue that you're earning at that time. So look carefully at these transactions, and you'll see patterns that develop about whether it's a positive and a negative on the asset side, or if it's a positive and a positive across the equals. I hope you found this useful.